Welcome back, everyone. On your Do Now, you were explaining or summarizing how banking system works in the United States. Hopefully, you talked about how banks were privately owned, not owned by the government, that they take people's money for savings and then use that money to loan out to other people. And the way they make profit is by charging interest on those loans. You may have also mentioned that the government is very involved in the banking system, lots of laws and regulations, um, lots of control on what they do, as well as insuring the money that gets loaned out. So if you save your money in a bank account, it's insured through the federal government. So if the bank fails or people don't pay back their loans, whatever it is, you still have your savings account. Today we're going to talk about the Federal Reserve. Sometimes it's just called the Fed. The job of the Federal Reserve is to regulate banks, make sure that all the banks, Wells Fargo, Chase, all of them are doing what they're supposed to be doing. They're following the laws, banking laws, and make sure that they're, being safe with everyone's money. They also regulate the money supply, control how much money is available in the country. And I'm not talking about how much money we print. That's controlled by the Federal Reserve as well. They tell how much to print. But this is more about like how easy is it to get money? How easy is it to get a loan? How easy is it for money to flow through the economy? So they try to control how easy or hard it is to get money um, to try and keep the economy going or slow it down. We'll watch a quick video on the Federal Reserve if you want to pause this one. The current chairman of the Federal Reserve is Jerome Powell. He and a collection, they call them governors, of people, they decide how the Federal Reserve is going to act. The president doesn't tell them what to do. Congress does not tell them what to do. They're kind of on their own making decisions for the financial health of the country. Now, they're appointed by the president and they have to be approved by Congress, but once they're in power, they do what's best for the economy regardless of elections. They don't try to manipulate things to get certain people to win. Their goal is to just make sure that the money supply is healthy for the economy. So they're going to try to influence the economy through the money supply, how much money is available in the economy at any given time. If you increase the money supply, it's kind of like the gas pedal in a way. It's trying to get the economy going. It should support and expand the economy. It should lower unemployment, but it comes at a side effect. This is going to cause inflation. If it's easier to get money, everyone has more money, prices go up. So yeah, people will be spending more, hiring more. That should help boost the economy. But like I said, it comes at this cost of inflation. And this is what the Federal Reserve had been doing for several years during the pandemic and a couple of years after, is that they've been making it very easy for people to get money. So the economy has been trying to get going. People are hiring, but you get lots of inflation. Now, they're not currently doing this anymore, but that was the policy for a long time, and we're feeling the results. They could also decrease the money supply. This is going to slow the economy down, make it harder to get money, which means it's harder for people to spend money and harder for companies to hire people, which means unemployment will increase. But we'll have lower inflation. Prices won't skyrocket. So this is sort of the policy the Federal Reserve is doing right now, not dramatically decreasing, but a decrease in the money supply to try and slow things down because inflation has been so bad. Now, they have three different ways of doing it. We'll go over all three, but there's one main one they use more than others, and that has the biggest impact. The first one's called open market operations. This is buying and selling of bonds. Now, a bond is basically a mini loan from people to the government. If you buy a bond, You give your money to the government, they give you a piece of paper that says, come back in 5 years, 10 years, 20 years, whatever, and it'll be worth more, right? Because you'll get interest on it. So if you want to decrease the money supply, you sell bonds to the people, you're taking money out of people's hands and giving them paper that they can't use. Right? So you're decreasing the money supply. If you want to increase the money supply, you do the opposite. You buy them back. So encouraging people to give up those bonds in exchange for money puts more money in people's hands. They buy more, people invest more, they hire more, all that stuff. This one is used very often. It's all the time. It has a quick impact, although it's not a big impact. It's very fast. Right? They could decide it today, and you'd see the impacts happening right away. They don't be huge, but they'd happen fairly quick. The second is called the discount rate. And this is the interest rate that the Federal Reserve charges banks when they borrow money. When a bank borrows money, they have to pay interest to the Federal Reserve. So if the Federal Reserve lowers those rates, that means banks can borrow money and then loan them out to other people at a lower interest rate. All right, so if interest rates are low, people will borrow more money, which increases the money supply. People are going to invest in their companies. They're going to hire more people. They're going to buy more stuff. That increases the money supply, gets the economy going. At a higher interest rate, people don't borrow money, and they don't buy houses, and they don't invest in their company, and they don't hire more people, and it slows things down. This is the most impactful of all the effects, of all the different tools. This one has the biggest effect. It doesn't happen immediately, but it'll have major impacts. And this is the one people watch the most. That's what people are watching right now because the interest rate is fairly high because they're trying to get inflation under control, and people are kind of waiting for that interest rate to come down so they can buy houses. They can start a company, and they can hire more people, buy a car, all those things. When those interest rates start to low, the economy will start speeding up again. Last, we have the reserve requirement. Um, the Federal Reserve has laws about how much banks are allowed to keep in the safe versus how much they're allowed to loan out. So they don't take 100% of everyone's savings and start loaning them out. They usually have to keep like 10% aside just in case. This one almost never gets used. But if they lower it, banks could loan out more money. If they raise it, they can loan out less. It's just a risky thing to do. Right? The banks have less reserve that if people want their money out, that wouldn't be there. It cause a lot of problems. So rarely do they use this one. All right. Your activity today is to read a little bit more about the Fed and fill in organizers about the different tools of monetary policy.